I bet. Just a quick review on why the day ended up being bearish. So, it wasn't anything too obvious, I'm not gonna lie. Like, I don't have, like, any, easy holy grail answer, that nobody else would have. It's pretty much just we're extended past all-time highs. We had reasoning to expect bullishness previously off this, daily wick that I had mentioned in my expectations. We want to see that get treated as an inversion, which we did, and then we traded into a target, a standard deviation level that I'm forgetting now. I don't know. I agree. I'm sure it's important. I probably should find it for the sake, but I really don't want to waste time. And you can just get that, like, we failed to reach the standard deviation, so we got pretty close to it relatively, so you can assume that that's enough logic. And that's the standard deviation off this, like, daily manipulation leg. Yeah, so we use that daily discount wick, so inversion premium wick, or discount wick now, to trade higher. And then we lose speed overnight and enter a consolidation, which is like kind of like a really tight consolidation right here, like within this range. And so retail is kind of seeing that as like a bull flag, you know what I'm saying? Especially in a situation where we're above all-time highs. We've just shot up so fast on Monday. Everybody wants to see it continue higher, and we're consolidating overnight. And we also have a large divergence with Dow. Yes, not really a divergence. They both don't sweep the high. But Dow, it's kind of very obvious that there was something, there was like a crack in correlation. So that set the stage for a potential shift in delivery. And then market open starts rolling around, and London kill zone doesn't take out Asia high or central bank dealers range high or low. So the Asia high and low were swept previously before London kill zone, so those are kind of like, you don't really want to pay attention to those. And then central bank dealers range high, central bank dealers range low. We consolidated within during London kill zone. So already I just want to like point that out for future reference. So I'll put these lines right here. 10 a.m. Eastern to 11 a.m. That's like, it's ideally just a no trade zone if that happens. It's not always going to be the case that it's like going to consolidate, but I feel like I've definitely been better off. Like, I've avoided a lot more consolidations and just like runs that I expected to happen that didn't end up playing out just because I avoided this 1 hour if this one scenario didn't play out. And then we get closer to market open and 6 a.m. Eastern rolls around, and the first fair value gap after that is an important fair value gap according to ICT. And you can take this bullish one potentially before it, because it's after 6 a.m. Eastern, and my chart's in Pacific, so ignore those times. But it's like right before this, like a couple candles before, we had this whole like range enveloping it, or at least like these couple of candles. So you can still take it. It doesn't work as well, you know. I'm not trying to cherry pick or anything. So I'm not trying to like. I feel like there is some logic though to using this second fair value gap, because overall the expectation is potential bearishness, or you can't really have too much of that, but because of the divergence with YM, you can expect a potential break in structure, kind of. And yeah, so it'd be a little bit more preferable to potentially use this bearish one. We ended up using it right away and running lower too. That kind of could potentially confirm it for the future as well. But, you know, even if you were to use this one, you can say, you know, in the morning we tried to come up to it and we just barely failed. That's also a really bearish signature. But because I'm using the bearish one, and that's what I was using in the morning as well, I wanted to assume that this, we were staying in the lower half of it and kind of we were being held inside of it, but being really sharp inside of it, and just constantly going lower. And then at market open, we try to tap it one more time and fail.
Is that our first presentation?
Yeah, so that's the first one after 6 a.m.
What time is it?
First one after 6 a.m. And you could use this one, and the logic still works, but if you watch ICT's videos on like how he picks and chooses first presentations, you'll realize that this one follows the rules a little bit more, especially because this body right here doesn't overlap. So this small portion in between this order block and the fair value gap, it's preferable if it was bigger for sure. So maybe you could take like one after this, but you can see it gets worked pretty nicely later on still. And yeah. So
it's a BPR too,
right? Yeah, because it's got this whole it's got like the overlapping fair value gap too, and it's got this whole block of price action. So not only this block, we've got like this little block as well. So
and plus breaker.
Yeah, exactly. So it's like a quadruple balance price range. So if it did come and tap it one more time, I would allow for that and maybe like just tap it perfectly and go lower. But then ICT's mentioned that when you have like something like this and it comes up, taps it once, and this doesn't count because this is immediate. And when we got deferred back to it. So we got deferred back to it one time, and then we try to trade lower again. Deferred back to it a second time. If it got deferred back to it a third time, it's very likely that it's not going to hold up anymore. And ICT's mentioned that. So it's really nice that it failed to tap it here. Even though if it did tap it, I'd still if it broke lower, I'd still allow for that. But it definitely would be preferred. This is like so preferable that it made it real nice and like logical to expect lower pricing in the morning just from that alone. And I haven't even gone into like the other logic yet. But yeah, if you did, by the way, take a short off this, when this came up again, if I took a short, my stop would be above midpoint of the first presentation at this point. Because if it got deferred back to it, I could let it tap the low, even though that's not preferable. But if it went above midpoint, it's probably going to like rail it, most likely. And yeah. But then yeah, from there, that's a weak signature. We don't tap it again. Break lower, we have the opening range gap that forms as a green box. And then quickly we fill it, and then fill it both ways with trading upside and downside trading. So trade down into it, then trade higher, and this is where we fail to tap the first presentation. And then we trade lower, and we create this fair value gap right here, which at the time I considered the first presentation, but I saw ICT's PDF, and he didn't consider this the first presentation. And I can see why, because the actual gap between the wicks is extremely small, even though if you take the volume imbalances, the fair value gap becomes bigger. So I think I just need to see if ICT says something about that, because I don't see too much logic behind not using this one besides like the wicks are almost like perfectly overlapped. So I'll just, I'll consider it that was the logic. So even though I was using this, so the logic that I was working with in the morning when I was trading it was that this first presentation, we trade into it, sharp above midpoint, trades beneath it, only wicks inside of it, and then aggressively breaks lower. So the logic still worked out in that case, but I'm going to go with ICTs because it ended up getting worked pretty nicely later on. And so with that, I don't even need that gap, by the way, because I have the opening range gap So we trade beneath it, trade up into the opening range gap, and only trade into the lower quadrant. Don't even trade up to the midpoint again after we trade beneath it, and break lower. And by the way, we got this mitigation block right here. You can consider it a breaker too, but that was pretty nice as well, that last tap to it. And then we aggressively broke lower and created what ICT considered the first presentation, and then traded into it and trade lower. And by the way, for high time frame targets as well, it's kind of hard to frame it because there's not much, like there's just fair value gap kind of in between this and the low. So the main thing you could use to frame it is quadrants and standard deviations, in my opinion. So, and I'll remove the daily wick just because it's still interesting to me, but I don't want to clutter up my chart. So assuming it's the morning, we trade into the upper quadrant of the range, and then every run above it, which, by the way, if you were just using this on like a scalp term, this could have been in the first presentation, could have been a potential short, as in pretty much just bearish order flow entry drill. So that order block, or not that. So when we trade up into the opening range gap, like I mentioned earlier, and fail to tap the midpoint and stay within the lower quadrant and aggressively break lower from the breaker, we create this order block, and the body of it, which aligns with the first presentation right below this consequent encroachment. We tap it, and the candle that taps it flips bearish. Tap it again, candle flips bearish again, and the bodies are respecting the first presentation low. And we've already had this like plethora of bearish signals. That's pretty much a short right there, I'm not gonna lie. And that can be like a nice easy scalp. I didn't take this, but that can be a nice easy scalp to like this low. Just like maybe this second time. Like maybe you gotta fill it, like let's say as this candle was trading up, and that's like pretty optimal still. And that's like 263 to 242. So that's like your 20 points right there. And then, yeah, we just kind of end up consolidating. We enter this high resistance that Slazzy was mentioning, or the Seek and Destroy that Slazzy mentioned earlier on. But overall, we're being sharp above, or when we enter the first presentation, every run inside of it is sharp. Like, you can see that this was a very quick run, trades out of it very quickly. This was a very quick run, trades out of it quickly. This was a quick run, trades out of it quickly. And every time it's trading into it, it's also sweeping buy side. So that's kind of like, if you see something, or if you see price going somewhere you'd prefer it not go, it's better if there's buy side, or like sell side where price is going. Just because it gives it a little bit more reasoning for it to go there and still like hold the same bias that you would. So like, okay, you hear ICT talk about you want to see it stay beneath the midpoint of PD arrays or whatever, and that's a bearish signature. And right here you can see it generally do that, but then this is a run above midpoint, but you can allow for that because it's just sweeping this buy side and it's just a sharp run. And the logic that it's exceedingly bearish still holds, Yeah, and then pretty much anything was good from there. If you didn't, so like this, if you wanted to try to take a short, unless you have like some obvious signature that like price is going to respect where you are right now, if we're still within the seek and destroy conditions, you have to put your stop. Like if you overall have like a bias for the day, like I know Toshiro somewhat likes trading like this, where he gets like a big move for the day and he holds on to it. So if you were trading like that, your stop would have to be like above first presentation, because you're seeing it trade sharply above midpoint. What if it wants to sweep out this buy side real quick sharply and then quickly trade lower before trading above first presentation? And that's the premium that's that's the extreme premium it's using for the seek and destroy. So, and I haven't even mentioned opening range yet, and that played into it as well, but this, I'm going to take off quadrants of the first presentation. This range that we're kind of generally trading inside of, this is what I consider the seek and destroy range. I feel like that's kind of the most obvious range you can point out that we consolidated inside of. And you can see that the first presentation was above the upper quadrant, which is an extreme premium. And when you see it go in an extreme premium and it's sharp there and it's in a seek and destroy, that's a potential signature that it might want to leave the seek and destroy. So that was one thing right there. And then I'm going to apply the opening range as well. So 9:30 to 10 Eastern, highest high and lowest low. Excluding the 10 a.m. candle or the 9:30 candle. And you can see we use that midpoint real nicely. So right here, failed to reach it right here, and then we trade beneath the low of the opening range right here, and then trade higher once above. So like, I also want to mention this. I was thinking about this point earlier. When you have an inversion level that you want to hold up, so like putting like in this case the lower quadrant of the opening range. So we use the midpoint to trade lower, and now I want to see, does the lower quadrant hold up? I have to allow it the first time. I have to allow it to wick above it aggressively, and it could close above it. Like this is still like, this whole price action to me is just a wick above it. Because as long as we trade beneath it and then reclaim it, and then reclaim it right here, and then reclaim it right here, as long as we're doing that, it's still valid to me. So like the first time I have to allow it to wick above it, but then as long as it reclaims it later, it's okay. I feel like I didn't explain that the best, but I think I'm going to move on. And yeah, so we use the midpoint to trade lower and then consolidate in the lower half, which is what you want to see. Ideally, in the lower quadrant, you want to see the most consolidation. And, if it's willing to stay within the lower quadrant, that's like the most optimal. And then we use the low of the opening range right here, plus this fair value gap, I think ICT actually, if you check his review I don't even need to explain anything else because I just go into ICT's review, but if we use this as a breakaway, then the next fair value gap. So using all the logic I just mentioned before of the opening range, when we finally work that lower quadrant one last time, and you can see that like kind of perfect respect where we tap it there, and then we aggressively break lower, you can assume that price might actually want to start spooling now, especially if we're entering a macro. And remember that time period I mentioned earlier that you wanted to avoid taking any trades, so because London Killzone didn't sweep the liquidity. So this whole section, it's actually good that we're avoiding this, because even though you see this signature that is being sharp above midpoint, you actually don't know that that's what it's doing at that time. So it could just break lower, maybe trade into this fair value gap, and then trade higher at the time. you don't know that it's going to have this deep retracement, but it does. And then, our time window opens at 11 a.m. Eastern. We trade higher into a premium, try trading into the midpoint of that opening range and fail, showing that signature of weakness within our time window of trading. And then we start to break lower. And then we do consolidate for another hour. So the 850 macro spools, but it fails to continue. So the end of, or going into the lunch macro, which you can expect lunch to consolidate because generally that's what it does, or it goes against what the move already is. So we've been bearish. You can assume that the lunch macro or lunch might want to go against the liquidity we've already kind of built. So, my bad, I just lost my train of thought there. But this macro hits the lunch macro at 850 or 1150 to 1210. And we spool lower. And then that macro ends and we enter lunch. And immediately we run after. So this whole run was potentially tricking buyers into stepping in. And then once this macro hit, it was sweeping all that liquidity. And then once we entered lunch, it was just kind of generating buyers again. That's the best way I can try to explain it. And then once the next macro hit, after lunch or like going into lunch's end and PM session, that's when we were ready to spool. And
your macros are the 10 minutes?
Yeah, I do 10 minutes. Yeah, 10 minutes before, 10 minutes after. Do you do 15 minutes?
Yeah.
That's fair. That's not bad either. Cause even ICTs, like, I'm not trying to like dick ride ICT, but he's mentioned that like, you can look for the runs to start forming 5 minutes before, 5 minutes after. So like, I wouldn't be like tripping about using that. Dude, I'm saying if you're doing all that already, you should focus on just looking at every 15-minute interval. Because pretty much all you're avoiding right now is the mid-hour, right? So
yeah,
and those are pretty important as well. So I'd say just like focus on every 15-minute interval. I don't put too much emphasis on it, and like focusing on it during the macros is of course better. But the runs can start mid-hour as well. You know what I'm saying? So like in this case, 11:30. That's when the bearish run fully like engaged. And then it created the high, and then when the macro started, that was enough logic to allow for spooling. But yeah, and then later we trade beneath midpoint. We're willing to really stay beneath it. So even on the 1 minute chart, we try to trade above it, not even a body laid above it. And this is post macro now as well. So the macro started the spooling, and the fact that we're continuing to spool. So normally if a macro spools, it can like consolidate after. But if it continues to spool aggressively and it spools even harder, then price is probably really going to run. And yeah, so that midpoint we trade into the lower quadrant, and then that's kind of where we hang around, and we're here.
This is the daily wick, or?
So the quadrants that I'm looking at here is just this range between buy side to sell side. So like on the 1 hour chart, from this sell side to this buy side, because like there wasn't any obvious like PD arrays in between. You know what I'm saying? Like when we got beneath midpoint, yeah, there was this like order block, but you know, I wanted something up here too besides just looking at, you know, some big fair value gap. And you know, there is still like information you can get from the quadrants, but I wanted a little bit more. I wanted something that was gonna have more emphasis. So like this range is kind of, it's, I don't know how to explain it, but it's kind of like a higher time frame. You know, like I can see this on up to the 8-hour time frame. Even to the daily time frame if I just took this daily candle. You know, if I just framed the quadrants of that daily candle. So that just the fact that I can do that makes this more important to me. And I can frame the fair value gap still, like midpoint aligns pretty closely to the upper quadrant with this bullish fair value gap. So I can assume that to potentially be an inversion, or if it wants to be bullish off here, then, you know, I can potentially assume it to be a bullish fair value gap. But my overall emphasis is on the quadrants. And previously, I showed at the beginning, I was, in my expectations, I had this daily wick marked. Because, yeah, I wanted to see that get inversed, which we did pretty nicely. But, yeah, I think that's all. Yeah. Alright, bro. Thanks for sticking on. I'll catch you later.
Bye.